Biggest risk after acquisition isn't what showed up in diligence. It's what shows up after close. The reporting delays, the cash surprises, the spreadsheet nobody fully understands, the finance process that only works because one person has been holding it together. That's when private equity operators realize the company looked cleaner on paper than it actually operates in real life. I'm Aaron Ludwig with Bluebird Partners. We help private equity backed and founder-led technology companies build the financial visibility, reporting discipline, and forecasting structure they need after acquisition. Because once the deal closes, the questions change. It's no longer, is this a good company? It's, can we actually operate this company with confidence? We stepped into a portfolio company about 2 weeks after close. The deal had looked solid, good ARR, reasonable growth, nothing alarming in diligence. When the sponsor asked for a simple cash position report, it took 3 days to get an answer. And when the answer came back, it was a spreadsheet built by one person, referencing four other spreadsheets that nobody else in the business fully understood. There was no 13-week cash flow forecast. The monthly close was taking 3 weeks, and the sponsor couldn't rely on the numbers. They had to make decisions. That's the risk that doesn't show up in diligence. It's the one that costs the most time. So what do you actually lock down in the first 30 days? Three things. First, build a 13-week cash flow immediately. That's the most critical operating instrument. It tells you whether you can fund the plan, whether you're at lender risk, and where the pressure is before it becomes a problem. If it doesn't exist, that's the first thing to build. Second, identify who actually owns the numbers. Most acquired companies, financial knowledge sits with one person. If that person walks out, so does the ability to produce reliable reports. That's an operational risk, and you need to know if you have it. Third, establish a clean operating baseline. Before you can manage to an EBITDA target, you need numbers you can trust as a starting point. That means a current close, validated ARR metrics, and revenue recognition has been reviewed. Get the baseline right, and everything else, the forecast, the board reporting, the lender package, follows from it. If you recently acquired a company or you're reviewing a portfolio company that still feels harder to read than it should, start with visibility. We created a simple checklist to help private equity operators identify what needs to be locked down in the first 30 days after an acquisition. Download the checklist and use it to spot the gaps before they become expensive.